Hello and welcome to eOption's webinar. We're excited to have you here and thank you for taking the time out of your day to join us. We're happy to partner with our speaker, Teddy Keckstad, a professional trader with over 30 years of experience, to bring you this webinar on kicking off the year with option credit spreads. My name is Gina Bocaius and I'm with Regal Securities, the parent company of eOption and its sister company, InvestTrade. And to provide you some basic logistical information, the session today will last approximately 1 hour. If you have any questions during the webinar presentation, please feel free to type them into the question box, and our speaker will answer those at the end of his presentation. Please use the Q&A box and not the chat box, as our speaker won't see what's in the chat box, and you should be able to find the Q&A box on your screen. Also, you can reach out to eOption's trade desk at any time if you have any additional questions after the webinar. We're always happy to answer your questions, especially about option trades. And you can access the recording of the webinar in the next week on our website at eoption.com. And we'll also be emailing you a copy of the recording in the next week. You'll also find it on eOption's YouTube channel, so make sure you subscribe. And for those of you just joining, we'd like to welcome you to our webinar on Kick Off the Year with Option Credit Spreads. And as eOption's name implies, we are a firm that specializes in option and stock trading. Our founder was a founding member of the Chicago Board Options Exchange in the 70s and has been trading stocks and options for over 50 years. And he created his ideal trading company for those who love and have a passion for trading. At eOption, we charge some of the lowest option rates in the industry, and all stock and ETF trades are commission-free, and options are just 10 cents per contract plus $1.99 per trade. We also offer a powerful trading platform, a mobile app, free trading tools, and live expert support on our trade desk. So we encourage you to go to eoption.com, which also has many resources to assist you in your options trading. We support option education, and we're glad you can join our webinar today to learn more about using options to trade in this volatile, unprecedented market environment. I'd like to turn our attention to our speaker now, Teddy Keckstad. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from our past webinars he's done for eOption over the last year, and we're excited to welcome him back today. And he has over 30 years of trading and industry experience. He traded on the Chicago Board Options Exchange, Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years, and he's been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked, and he is the author of High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University in Chicago. And without further ado, I'll turn it over to Teddy Keckstad. Thank you.
Thank you, Gina, for that introduction, and thank you, eOption, for hosting this webinar today, and also to all the attendees. So now let's get on with kick off the year with option credit spreads. Okay. And here we go. So you already had a little background about me, so I can skip on that. Real quick, we want to give you the disclaimer from eOption to remind you that this webinar is for illustrative and educational purposes only. And I always put up my disclaimer for my company as well for anything that I do. Okay, so today you're going to learn how to maximize your option trading potential. Use eOption for your stock, ETF, and options trading. Free option strategy tools like Options Play are available on their website, which after this webinar you may wish to use. Free option strategy guidebook is also available on their website. There's a paper trading account that you can use to test your strategies like the ones you're going to learn today. And then also remember that ETF and stock trades are commission free at eOption, and all option contract commissions are only 10 cents per contract. All right, what you will learn today. Well, first of all, the thing you're going to learn is how to get paid first. So, but you're going to learn how to trade stock and other market movements without large capital allocations. You're going to also learn how to expand your portfolio diversification by using these strategies today. Also, you're going to learn how to maximize your potential returns with options. Then also, bear and bull directional strategies will be addressed today. So whichever side you like to trade or are prepared to trade, or what kind of system you have, you'll be able to adapt this to either type of strategies. And also you're going to learn how eOption can help improve your bottom line. One is through the cost efficient basis right there to lower your cost. And there's other things too besides the tools that are available. So without further ado, so why stock option strategies? Well, first of all, they lower your cost basis. At eOption is only 10 cents a contract. We covered that. So that's one thing that's going to help you out through these strategies. The spreads that we're going to be covering today are 2 options for each spread. So that would mean that you're going to be, it would only be obviously 20 cents a spread for that because there's 2 options there. So options help you to diversify your portfolio because you can trade a much broader range of stocks with your allocated capital. We're going to look at 3 different examples of stocks today with credit spreads. And when you see the difference in pricing on these stocks, you'll see how if you were trading the stock outright, buying the stock and what have you, what kind of a capital allocation you would take to take advantage of just small to even large movements in the marketplace. And you'll see how that comes clear today. Now, options allow the smaller to large and to larger investors the ability to capitalize on trendy markets that are highly liquid. Remember that all the equity markets that have options markets these days, they're super liquid, which means that when you're super liquid, you have very tight spreads getting in and out. So it's not like years ago where you had to really put in limits and you had to be careful about getting in and out of spreads because the pricing was so wide. Now, because there is so much volume, meaning liquidity, the spread to get in and out is tighter, and that helps the option trader and investor these days, especially because now everyone's off the floor and it's computerized. So this is a very important cost control. So remember, part of trading, to be successful, one thing is to always try and control your costs first, because whether you win or lose, your costs are a variable that are always against you. So that if you can control and minimize and maximize your potential through whatever strategies you use by using that technique, it will always improve your bottom line. That's just a basic accounting fact. So now trading these products is also similar to trading in normal equities, but with a higher potential ROI and controlled risk. So what does that mean? That means your return on investment through these strategies is higher than if you would just be buying the stock outright, or even worse, shorting the stock, which is a very, very high risk, educated trader and capitalized trader thing to do. And also we're going to control risk. Controlling risk is one of the key principles to money management and being not just a successful trader and investor, but once again, controlling and maximizing your bottom line to benefit you in the long run. So today's focus, credit spreads. Credit spreads are spreads where you get paid first. You're going to be buying and selling an options simultaneously, but the net effect is that when you do that transaction, in your account, you will have a credit, meaning your balance will go up. Now, we will go over the risk and what that means when that happens. So now these strategies that we are going to use today are both bullish and bearish strategies. So whether you're looking for the market to rally and go up and be a bull, or to fall apart and break down and be a bear, these strategies can be utilized. So there's always for credit spreads, whenever you're picking a direction, you'll always have an option, no pun intended. So another thing about credit spreads is that you will have defined risk. So now the defined risk comes into play for money management. You always want to have defined risk, whether you're investing, trading, whatever you're doing in the markets. If you do not have defined risk going into whatever it is you are going to do, not only are you gambling and being foolish, I promise you in the long run, you will only hurt your bottom line, no matter how often you are successful on an investment or a trade or what have you. The other thing about these spreads is they're simple to execute. Simple execution means that whether you are a complex and experienced veteran trader or investor, you can obviously execute this strategy. You probably have done this before. Maybe today's webinar will help you learn how to use them more in a better fashion. For those of you that have never used a credit spread, the execution is very, very simple. It's a very basic strategy to implement. Now, today's focus, short-term versus long-term. We're going to go over that on how you implement these strategies. Now, for those of you that have watched webinars in the past that I've done for eOption, for a lot of the strategies that I have done, and for the most part, you use options that are 30 to 45 days or more out as far as before they expire. Today, we're going to have short-term versus long-term expectations on these strategies. For the most part, the options that we will be looking at, they're options that expire in under 30 to 45 days, sometimes even under 30. And we're going to go over the pricing and how you evaluate which ones are the ones you would try and utilize. Now, the reason that we're going to talk about this short term and use shorter term options is because we're going to talk about a couple of the Greeks today. So what do the Greeks have to do with it? Now, before you start getting worried and start to have some math anxiety, don't worry. We're not going to have any XY graphs and curves and all kinds of things that you're going to be looking at and be confused about. So we're going to lay it out very straight and simple, with a very simple definition, and you're going to learn how a couple of the Greek variables work in your favor for these spreads. So with that, now let's move on to the next slide. Okay, so what is an option credit spread? Okay, first of all, a credit spread is the opposite of a debit spread. Pretty obvious, right? So it is a vertical spread, okay? And it is always defined, okay? So now when I said it's the opposite of a debit spread, it's like an obvious, he's saying that it's obvious. A debit is where it would you would be paying money to put on a spread, okay? Remember, in a credit spread, you're taking money up front. So your risk is always defined because the money you take from your credit spread, that is the maximum amount of money that you can make on the trade. It is defined right there. But just like that's the maximum amount of money you can make on the trade, your risk is also defined by the difference of the options. And we'll get into the pricing on that. So that is where this vertical spread gives you the option or the ability with these options to define your risk and take your profit right off the bat. So if your trade is correct, you will have your money up front. Now, obviously, not every investment or trade goes the right way. You will have losers, but your risk will be defined with that. So now, why is this a vertical spread? The reason it's a vertical spread is because we will be trading a bullish or bearish direction. Okay, but if the market doesn't move, it's not the end of the world for you either. And you'll understand that as we get into the spread basics. So typically these spreads do well with shorter expirations. Okay, this is because of delta. Okay, now a negative delta will help a bear call credit spread, which is one of the spreads we're going to go over. And a positive delta will help a bullish put credit spread, which is another spread that we are going to go over. Okay, this helps the premium the premium decay faster in both instances. Notice the dollar signs. Remember, this is a credit spread. So you are selling, you are a net seller, you are taking in money right off the bat. So if time decay helps the premium decay faster with these shorter term options, that means that for whatever, when you sold the option, as soon as you sold that, right off the bat, that value is kicking in right away. So whether it's a day later or 2 days later, it's accelerating your way no matter what in price. So if the market doesn't move at all, the value of that spread, if you were to get out of it, you would be able to make money because of time decay. It would be moving in your favor. Now, it may be very slight if the market doesn't move, and obviously if the market goes the opposite way, that changes the pricing too, but that value will work in your favor. Now, another thing that helps you is that out of the money credit spreads have a large positive thetas that will decrease an option premium quickly under a shorter time frame. This is also money. Now, why does it say out of the money credit spreads? Well, the reason is that these spreads, when we go over them, we're going to look at where the stock price is. And then if it's a call spread above the market, we will be using two options that are the strike prices are above the market price. And the opposite will be if they are put spreads, then both the strike prices will be below the stock trading price. So that's why they are out of the money. They're not right, or if they were at the money, they would be pretty much right at the stock price. So we're going to be putting these spreads where they are actually away from the actual current market price. So that's why they are OTM. So now we're going to get into why delta and theta help you. Remember, delta, a negative delta is good for your bear call spreads, and a positive delta is good for your bullish put spreads. Now, theta is something that's very easy to remember, okay? If you can remember time decay, then you can remember theta. Theta and time decay are synonymous. They mean the same thing. So when someone refers to theta, they're trying to talk sophisticated and mathematically in the Greek way. If they say time decay, they're saying it in kindergarten terms, and also so that everybody understands for sure which Greek you're talking about. In time decay, the closer you are to expiration, the more it works in your favor. So think about it like this. When you buy an option that's 3 months out, it's good. Your time decay, since you have so much time, that time value doesn't move very quickly. So when no matter where the market's going, that value doesn't move for that option. That's locked in your premium. But when you're selling premium, you want that to disappear because you want to sell something for more than what you're going to buy it back, or you want it to expire worthless. Okay, that's how you make your money. So this is where time helps you right away. So remember, delta is the amount an option price is expected to help you as far as when it moves. Okay, if it moves in your favor, that also helps the premium work in your favor. And with the theta, that's just the time value. So now we're going to get into these examples. So for long term, the time decay is positive, but it's slow. Okay. For the long term, delta moves in the favor of a position, but not as fast. Theta also works in your favor, but not as well as with short-term options, remember? So in the long-term options, that's why you don't use credit spreads. Not that you can't, and we're going to have an example where you might. We're going to show you these things, and then you'll understand these Greeks, and we're almost there. We get to this last slide. We're going to get to the charts, and you're going to be like, oh, now I know what he's talking about. So use these in place of longer-term directional trades. So that's when you would use one of these credit spreads, maybe with the further out dates, okay? And that'll become clearer to you when we get to the charts. For short term, and this is where you make your money, remember, you're getting paid up front. So if you're getting paid, you want to make sure you keep your money. And that's where credit spreads are great, because time decay is almost gone from the premium right away. It disappears. From the time you put it on, it is moving. It just keeps on going in your favor. Once you sell it, the value of the option goes down because time is ticking down. Think about the hourglass. When you first flip it over, it's filled with all kinds of sand and it looks like it's just moving really slow, the whole volume. But once you get down to that bottom and it curves in, it starts just flying, or at least it appears to be. That's how time decay works. So delta helps to reduce the spread premium quickly also. Okay, so when you have these two variables, that's what's going to happen. And now we're going to show you how to take advantage of the short-term movements in the market or lack thereof. So Amazon.com is our first example here. And when I first put this webinar together, it was at the end of the trading year for 2020. So now we are looking at options that are expiring on the end of this week, which would be the 15th, because today's the 13th. So I picked options that would be within basically 2 to 3, 4 weeks for most of these examples, because that will help you with the Greeks that we're talking about here. Okay, so now Amazon, which you're all familiar with, topped out on a monthly basis about 4 months ago. And they had this little bearish sell signal called a bearish engulfing line. Okay, so just you don't have to worry about whether it is or isn't going to go up or down. This is for the examples. Plus, we needed to have a reason to go for a direction. So we have an upside risk level that sets us at 35.52, and we have a downside risk level. That's the range for the last high and the low. So we're trying to find a spread directionally, because if we're going to be bearish, since we have a bearish sell signal, then we would be putting on a call spread. So we would be selling the market above the market. Okay, so we would, in this case, the market was trading at 3,256, but because our upside risk level is so high, the only options we could look at would be at 3,550 and 3,560. So in this case, you would be selling the lower call at 35.50 and buying the 35.60 call. Okay, now that would only yield a net credit of $1. It's because it's so far out. Okay, now the same thing is to the downside. If you look, or excuse me, even if you go out just one more week. Now remember, just the one more week would give you a time premium value. So if the same spread, the same options, they should be, if they're expiring 1 week further out, because of the time decay, they should actually be worth a little bit more. And you can see this from the pricing here, that the first one here, the first spread, is where you're selling the 35.50 call and buying the 35.60 call with an expiration of January 15th. Then we look at the ones from January 22nd, a week later, that are expiring next week. That would be a 35.60 call that you would sell here, and you would buy the 35.60 call to cover the other side. Now this would give you a credit of $1.82. So what does that mean? Well, you can see that because of the two Greek values, just 1 week alone, the very same strike prices, if you were to put on that trade, this credit spread, you would get more for that 1 week. And that's because your delta would have longer time and have longer time for movement. And then also your theta, which is time decay, there's more value there. So that's where you're looking at the same strike prices, just different expiration dates. And remember, you're going to be selling and buying the same expiration date at just different strike prices. So in this case, it would have been a 35.50 call and a 35.60 call. The only thing is it's too far out. There's no money in it. So the value you would take with these spreads would be $1, which is 100, or for the second spread, $1.82 is $182. The only problem with this is that your risk is between 35.50 and 35.60. So that's $1,000 risk. Now, if you're only taking in $100 or 182, you're laying huge odds. So this is where pricing and the time decay, even though there's a short amount of time, you would be laying extreme odds. So if you were like a betting person, that's when you hear about people laying odds where you bet like $400 to win $100. That's what you would be doing in this kind of situation. So, and I don't like those kinds of odds. So once again, with these credit spreads, real quick, and this will start to get clear. We're using these easy numbers to get you with the Greeks real quick. The January 15th spread, you would have been selling the 35.50 call above the market for $8.80, which is 880, excuse me. And you would be buying the 35.60 call for $7.80, which is 780. That would be a net credit of $1 or $100, okay, for the pricing. The January 22nd options, which would be expiring next week, next Friday, you would be selling the same type of strikes and buying the same strikes, just a different expiration, remember. So selling the 35.50 call would be $15.27 or $1,500. That's a $1,527 that you'd be selling. And then you'd be buying the 35.60 call for $1,345 for a net credit of $1.82, which would be only $182. Now, granted, there's not much time left. So, but there's just, I mean, the market has to go rally a good amount of distance to get up there, but still there's not, you're laying a lot of risk. Okay, so we have a couple of questions. We're going to get to those. They're good ones, but I just want to get through these examples so you'll start to see these spreads. So let's look at the Amazon. This is the same time. I did it on the 31st, the last trading day of the year. This is the daily chart. Now, there was this bearish engulfing line sell signal 2 days before the market end of the year. So now we have options that we can look at where there's a little bit more pricing and ability and where to make some money. So these are much closer though. So now the market was trading once again at 32.56 when it was settling at the end of the year. So these are the options you could have looked at on a different level for strikes. In this case, for January 15th, if you look at the orange lines here, there's 3,350 and 3,360. So that means that's the 33.50 call and the 33.60 call. In this case, you would be selling the lower one because that is the more expensive one, and you buy the higher one. That's the cheaper one. That's why you get a credit in these spreads. You're selling the closer one and selling and buying out the one that's further out. So in this case, you get $1.66. Well, that's kind of like the last options, and these are much closer. Not a lot of VIG there. There's nothing. Why would you take on that kind of risk, huh? Interestingly enough, though, you go out one more week to next week, and this is where you find your opportunities with options, folks. Here you have a next Friday expiration. The credit is $7.32. That's $732. In this case, you would still be selling the 3350 call, which is this first one here, which is just above this last high on a daily basis, because this is our risk level. So remember, we looked at the monthly chart. Now we're using this daily. It's much tighter. And then we would be buying the 3360 call. So these prices here would be where you're selling the call at $33.50 for $51.75, which is $5,175. Remember, you always multiply by 100. And then you'd be buying the 3360 call for $4,443, which nets you the $7.32, which is $732. Now, in this case, here's something where you could be shorting Amazon.com with this credit spread synthetically, and you would initially take in $732. Now, the nice thing about it is that your risk here is the difference between that $732 and the $10, which is $1,000, the difference between these two strike prices. So that's only $268. So now you're risking, when you're taking in almost 3 times what you're risking. So these are good. This is where you get your ROI. So in this case, instead of where I showed you those first 2 spreads where you would be laying huge odds, now you're getting odds. You're getting huge odds because right up front, you're getting paid, and your risk is that not only does the market have to rally all the way above 3360 for you to lose, if you do, you only lose that $268, which would equate to the difference of these calls on the spread once you get out of it or once it goes through that price. Now, should it not get above 3360, it won't go that far and you won't lose as much. As long as it settles somewhere above, below 30, if you look at 3,350 is your first call level right here, since $7.32 is your credit, it has to be $7 above that. So that'd be 3,357.32. So as long as the market stays below that, you would still be up money on this credit spread. Okay, so now this is where the value of looking at these things, and when you have bullish and bearish opportunities, how to find value and how to take opportunity in the market. So in this case with Amazon, we found that first we had a monthly sell signal, but there was no value in credit spreads. There was only risk. You'd be laying odds. Then we switched to the daily. We found a confirming daily sell signal. But with this one, we found within 3 weeks of the date of when we were looking at the market, a credit spread that had a high ROI, which was the January 22nd. That's the second spread here. So the first one, remember, the same strike prices, only 1 week's different. You would have been laying, look at this, you would have brought in a credit of $1.66. That's $166. You would have been risking over $800 on one spread to be short synthetically Amazon. Ironically, how much would it cost to be short 100 shares of stock at Amazon at that price? Now are you starting to see the value of credit spreads and options? Think about that one for a second. So we'll get into that further. But once again, we have January 22nd here. You sell the 33.5 call, you buy the 33.60 call. These are the same strike prices. You're doing the same action. You're selling the closer call and you're buying the further one out. This one, however, you get a credit of $7.32. That's $732. So now, if you were to have done this spread, and today, if you would have wanted to get out of it, see, now here's the beauty of it. If you would have done, you couldn't have done the January 15th spread that expires in 2 days. It wasn't worth it. But you could have done the January 22nd that expires next week and get out of it right now for a debit of $1.10, which is $110. Now, remember, if you were to get out of it as a debit, that's because you would be buying it. So to buy this spread back, it would cost $1.10. So you're going to have a profit of $6.22 or $622 in the past 2 weeks had you initiated this credit spread being short synthetically Amazon.com. Pretty interesting, isn't it? So, and the thing is too, is if you still thought it was going down and you really, now here's the beauty of it is there's only $1.10 left. There's no reason to wait until next week for expiration. You would just get out of it right now. Why wouldn't you? Because now you have all to lose and nothing to gain really anymore on this spread. So now you would have a perfect opportunity to have shorted Amazon stock for 2 weeks and it wouldn't have cost you very much money. And you would have had, guess what? Your account balance would have gone up right off the bat. Now, obviously, there is, because of the difference, you always have the risk you have to cover. So in this case, your account would have had held for margin $2,268, but that's it. That's it, because that's the only, everything else was paid for because you already have the money. So no matter what, this is the case where you get paid up front, you have an opportunity, and you can exercise that opportunity and have a huge return on your investment, meaning a high ROI. If you shorted the stock, you would not be able to take advantage of that market movement. Had you bought the puts also, because the thing is, Amazon, when I did this example, when I first looked at the option pricing for these spreads, Amazon was trading at $3,256. Today it's trading at $3,173. So it's only at basically $75 lower, which is not much at those prices. Okay. So even if you had bought in a put, that would have had to be at the money or above the market to really have seen any value. Okay. And here's the problem is, had you bought a put, because of those two variables that we talked about, remember Delta and Theta, we didn't forget about those, your value of buying a put would have started to decay because of time and also the market movement that would have also worked against you. So then being outright a put would not have been as good as putting on a credit spread where you get paid first. Pretty interesting, huh? Okay, so here's another thing that really blow your mind. So since you're starting to get the idea of taking money up front, look at this. We had the bearish engulfing line sell signal on the daily. Remember, this is the same chart, and we have the January 15th example with the $1.66 credit, and then we have the January 22nd for a $7.32 credit. Look at this one here. If you would have done this trade and you wanted to actually, this is where I said you always want to do it within 45 days, 30 to 45 days, you still could have done a January 19th, okay, or February 19th, excuse me. That would have been pushing the barrier. But look at the pricing. The same strike prices, selling a 33.50 call and buying a 33.60 call would have had a net credit of $9.20. Now, here's the beauty of this one, folks. Now, normally I would say you don't go that far out, especially for a credit spread. Well, now here's the thing though, is you're only risking 80 bucks. Like right off the bat, this is $9.20. Okay, that means you take in $920. The spread is only $1,000 wide. That's $10. So if you take in 920 and it's $1,000, that's the risk altogether. Your risk is only 80 bucks. So if you were really bearish this market, okay, then, and then wanted to have a little bit longer term, that's when you would stretch it out to something like next month. Okay, so that would be, now if you look at our chart here, you can see these vertical gray lines that shows the first one is January 15th, the second one is the 22nd, and you can see how this chart in the market would possibly wiggle into here no matter what. By time it crosses that. Out here, this other line, that's how far out in time. So the market could scream to high all-time new highs, in which case you would lose this on this position, but guess what? You'd only lose 80 bucks. Think about that one, folks. If you wanted to short Amazon.com, you wouldn't be able to stay short through February 19th if it's kept on railing through and made new highs. You'd have to be losing on margin. If you put on a credit spread, you'd have lost 80 bucks. That's it. You know, so this is where you find some huge value. Now, here's another interesting fact for you. Let's say you did put on this 219 credit spread and didn't want to do the $7.32. Today, you would be able to get out of it for $5.08, meaning $508. Okay. Now, the thing is, because of time decay, the delta and theta, there's still more premium in there. So that means that you only were risking, but now you don't make as much money. Now, remember, on this first one here, the January 22nd, you would be making $6.22 or $622 on the credit spread if you were to get out of it today. This other one here, you wouldn't make as much, but that's because there's the time decay value. Remember theta, time decay? There's more time, so there's the time premium. So remember we're going to teach Greeks for especially the newer people. Time decay, the longer you have, doesn't matter whether the option's going up or down, there's always a time premium. And the further you go out, the more of it there is. The closer you get to expiration, the less there is, and the faster it erodes. All right, so now we're going to start to get through some stuff real quick. So real quick review on that one. You took in a credit of 920 if you want to do that further out option by selling the 3350 call and buying the 3560 call. So the total debit on that one and the profit would have been $5.08 or $508. So two different ways to play that same credit spread. So now Walt Disney, remember Disney, they're streaming everything and making a fortune right now. Everyone's buying Disney Plus and signing up because they own Star Wars and God knows what. Well, look at this chart of Disney. There's two big gaps that have been there for the past couple months that need to be filled. Why do I say that? Well, it's not that they have to be, but there is a trader's adage that all gaps get filled. Now, does that mean it's going to happen tomorrow or maybe even ever? No, not really. But it's a reason to look at a type of spread, which would mean we'd be playing the short side. So in this case, we'd be looking at the January 15th and also the January 22nd option expirations. So that's this upcoming Friday and next Friday. In both cases, we're going to look at the 180 call and 190 call strike prices. In both cases, once again, you sell the closer strike price and you buy the further out strike price. In this case, if you wanted the January 15th spread, if you wanted to put it on a couple of weeks ago, it would have been for a credit of $3.54. And the one that goes out another extra week is $3.85. Now, this would be a case where since the pricing is so close to gain an extra week, I would probably say, why not take out the January 22nd one, especially if you were really bearish this market. So just because the pricing is so very, very close. Now, what happens here is that in this one here, remember the January 15th, you are selling it for the 180 call, which is the close one, buying the 190 call, you get a credit of $3.54. Today, if you were to buy it back, you would have had a debit of 53 cents. Now, here's the thing is, you're risking 2 to 1 on these trades. So this is where credit spreads are for the person in this situation. When you start to getting these smaller values for the credit, if it's going to be between basically $300 and $500 or $3 and $5, that's when you're looking for the person that really wants to go short. You have a sell signal. Okay. You really need to have a reason why you're bearish the market. Okay, so that's very important because of the value. Remember the spreads that I showed you where we had $7, $6 credit, $8, $9 credit. That's where you have an opportunity because one, you're getting paid up front always, but you actually have something where you have a return on your investment. If you're right, you're getting paid 2 times, 3 times to $1 that you're risking. You know, in this case, you're laying odds. So when you're laying odds, you want to make sure that you really are a bear, you know, so instead of being a short trader, which I never suggest anyone shorting any stock because of the margin that it takes, you have to be a very sophisticated investor. However, that doesn't mean that you can't go short the market. Or here's another thing is, let's say that you're long Disney and you want to stay long Disney outright. Well, then putting on these credit spreads, that's why you would do it, because you've probably heard of doing covered calls. Well, covered calls really don't give you that much value for what you're doing. Not that I don't suggest those strategies. There are times to do it based on the level of investor or trader. However, you know what's a better idea than covered calls? Credit spreads. So that's a case where, you know, why you're probably been asking yourself, well, if we have these cheap credit spreads, why would we use them? Well, there's all kinds of traders and all kinds of reasons why we use strategies. So remember, once again, when we started out, I was saying we're going to give you reasons where if you're a bull or a bear, how you can execute certain strategies. Right now, I was just showing you, because of certain examples, why to be long or short. Okay. So in this case here, if you would have done the 1 extra week, remember how the pricing was very similar? If you were to get out of it today, the debit would have been $1.53. Okay. So as far as what you would have made, you wouldn't have made as much on the one that goes out an extra week next week, remember? And that's because of Delta and Theta. Remember time decay, those values are there. So remember why I said, like, you know, the first one looks like, well, if you wanted to be short longer, then that you would do the January 22nd. But if you were just looking to kind of capitalize on the movement, the 2-week one is the better one, because you know that theta, that time decay, that erodes. It's basically like hot potato. It's like you want the spread to go, you want the market to break, but you really just want the time to disappear and just get out of it and take your money and run, you know? So, and that's where these values, I think, might start to becoming clearer to you. So we're going to give you one more example, and then we're going to get to our questions real quick. So sometimes it just does not add up. Yeah, that is misspelled, but it is, it's kind of fitting anyhow. So in this case, we have 2 examples. We have this, and these are both January 15th. We have Pfizer. Now, ironically, Pfizer, when we did this example, was trading at 36.81, and today it really didn't move any. It's pretty much right where it was at. Now, Pfizer is in the news every day. We know that. We don't need to talk about why, but we hear about Pfizer more than we've heard about Pfizer in decades. So let's just say you're either bullish or bearish. So remember, if you are bullish, you would put on a put spread. That's these red lines right here. This is the $36 and $35 strike prices, these red ones. If you are bullish, or excuse me, bearish this spread, then you would be selling the call spreads, which is this $37 strike and $38 strike. Remember, and here's the stock trading right in between these 2 credit spreads. So in this case, these blue lines, you would be selling this for a net credit of 93 cents. Or you could do this put spread down here for a net credit of 3 cents. So this is either $30 or $93. There is not a lot here whatsoever. So this would be a case where you're like, well, why would you put these on? You know, and the interesting thing enough is that sometimes it just doesn't add up. There's no value. You would think that even though this market, the stock is at a much lower pricing basis because it's only trading in the 30s versus the 3000s like Amazon that we looked at, that these options might be worth more, especially with all the volatility and news. But sometimes it's just not the case. They're very liquid, but there's not enough VIG here. So there's not much here, but this is a situation where, for instance, like I said, instead of doing a covered call, where let's say you own Pfizer stock and you can see how even in the midst of, there's reasons why most people would think it would be going up right now, that it isn't. So if you think that there's a chance that, you know, it could stay sideways or not get its real big rally, then that would be a situation where you would be selling these calls right here. Okay. Because you're not looking for it to really go up. Okay. Now, if you think it's going to go up now and is pretty much based. Now, remember we were talking about gaps. There's a gap here and a gap over here. 2 gaps were filled. This market could be ready to explode to the upside over the next week, week and a half. You know, in that case, you would be putting on your put spread. Okay. So once again, real quick with the Pfizer, if you were to put on the January 15th, there would have been only a credit of 93 cents, which is $93. Today, you could have gotten out of it for 14 cents, which is $14. So there's not much there. But once again, even with the put spread, if you were just looking for a short-term little insurance policy versus doing like a covered call or whatever, you would use these examples. And the same thing is with this put spread here, there's not much in it. You would have had a credit of 3 cents and today it would have been a debit of 4. So you actually would have been, you would have been scratching to losing money on that one actually. So there's nothing there, but as far as, unless you're, like I said, using it like a covered call. So you're only using it to try and let it erode a little bit. And if it does go against you, you own the stock. But if you don't own the stock, I wouldn't suggest doing it without having a high premium. So once again, with this, you should through this, you should have gained some ideas on how to maximize your option trading potential. Remember, we showed you ways how you can use credit spreads instead of going short and having all that kind of risk and margin where you can get paid up front and you know what your risk is defined. And you can use this on stocks, ETFs. Remember to also check out Options Play and also this option strategy guidebook at eOption.com to help learn how to use these strategies. You can test it with the trading account that they also have, or the paper trading account. And also remember that the ETF and stock trades are commission free at eOption.com, as well as their option contract pricing is only 10 cents a contract. So with that, let's get into some questions here. Let's see, why set up credit spreads on P&L there, the answer this for. Okay, what percent of your account should you risk? I've read 5%, i.e. 500 per 10,000 on an account. That is a very, very good question. When it comes to how much you should risk, well, first of all, it depends on, are you talking about overall risk or on an individual trade or investment? For sure, you never want to risk more than 5% of your total account value of more than 5%. The reason for that is you have to think about how much of a return you need to make back losses. Okay, and the reason I'm just going to get, there's two things I'm going to get at you first here. If you had all of your money 100% in an investment or a trade, and let's say you lose 5%, we'll just use even the 5% as an example, okay? That money that you have to make back now on that 100% of the money you originally had, now you only have 95% left. To recoup the money you lost, you have to make more than 5% to get back that money, okay? Everyone understands that. Now, if you only had 5% of your account at risk in any one investment or trade, when they go south, whether you lose only 5% or 50%, which you should never lose that much, you should have risk defined and not have those kinds of issues. But should you have those issues, that's why you have it spread out in increments like that, because you have more bullets. It's like one of my traders and mentors, when I first started working as a clerk when I was 18 years old, I asked them, like, what is one of the best things of advice that you could give me to know about that I should always remember? And you know what he said to me? He's like, Teddy, he's like, you see this pit, you see these boards, he's like, these markets are ticking 5 days a week unless it's a holiday. He's like, day in and day out, whether you or I come in, whether we're here or sick or not, whatever, this stuff is here. He's like, the whole point of being here is to make money. He's like, you want to be able to keep coming back here. He's like, so don't risk it all in one day. He's like, because if you do, odds are you're not coming back here. But guess what? The opportunities will still be here. You just won't have those anymore. So if you put all your eggs in one basket, and the more you risk, that's why you diversify a portfolio. You have more than one stock investment. It's not that you are missing out by you didn't put it all in this one stock. Well, yeah, you're also not missing out on a loss if you put it all in one stock, or trade or investment. So yes, 5% is definitely the most on any trade or investment that you should, if you are balancing out, and these are money management rules, whether you're option trading, stock trading, ETF, or whatever. Let's see, can you quickly say how to determine your strike price? Yes, the strike price is for your credit spreads. Now remember, if you are having your bear call spread, which means you're buying the closer call above the stock price, the first one, and then you would be buying or selling a higher call price, usually $5 to $10 out above it. So depending on the option, I like to usually do $10 and get a decent premium, but you could also go tighter. Just remember that you take your stock price, and to figure out your strike price, if it is a bear call spread, your first strike price above the stock current price would be the call that you would be selling, and then you would be buying a call above that at a higher strike price. I recommend $10 higher. You could also do $5 higher. you would have less, you would have less risk, but you'd also have less of a bang for your buck as well. The same thing would be to the downside. If you were putting on a bullish put spread, meaning you want the market to go up, then you would look at the stock price where it's currently trading. You would sell the first strike price put below the market, and then you would buy either $5 to $10 below that strike price to counteract act the part to get your credit. And that's where you'll be buying that in. So then that would give you your net credit for your spread. And remember, your strike price is above or below, whether it's a bullish or a bearish call or put spread. Okay, how do you select strikes? I think that question was just answered with that one. Does the profit come when the option trade is closed, close to expiration? Okay, no, that's fine. Don't worry about your English there. That's great. That's pretty funny. Very good question. Your profit from your trade. Remember, you get paid first. So here's how your profit works. The stock doesn't move at all whatsoever, and you could let the options just expire worthless, in which case you would make the full credit minus your transaction cost. Or the market could, for instance, like in a bear call spread where you want the market to go lower, the stock tanks. It goes down like 30 bucks, 50 bucks, whatever, who knows, it's so far out of the way. You can let those expire worthless also. Okay, now if they expire worthless, then you realize once again, the full credit minus your commission. Now, when we were doing these examples, remember when I showed you about how you had a nice credit, now you could get out of it today, even whether we have 2 more days or next week to expiration. If you've realized the majority of potential profit in your credit spread, whether it's the call spread or a put spread, and you only have 2 days left, like in the one example, the credit was $7 and some cents or 700 and some dollars. Now, if you have 2 days left and you can buy it back for around 100 bucks and lock in your $600 today, and your risk is gone, and now you have that, then that capital is yours. No one can take it away unless you spend it or put it on and lose it in another trade, then that would be the right time to get out of it. You don't need to wait till expiration. Now, if the market goes against you, remember, like if you have a call spread on and all of a sudden the market rallies above it, that's where you can lose the difference of the credit and the spread difference of your strike prices. So if you have strikes that are $10 apart, that means the risk is $1,000 or $10, okay? And you subtract your premium that you take up front from that. And that's why you look at the ones where you have, like, for instance, $400 to $600, $700 or more in premium. That's where you're getting 2 to 3, 4 to 1 odds on your money. Now, if you're going to be under 300 or around 300, that's where you're laying odds. And that's why I said you want to be careful about that. That's when you really would be trading directionally and you're focused on that. Like instead of going short, it's better to put on the credit spread because you're not risking as much as you would if you were doing the outright stock. Next question, do you use Delta? Okay, remember Delta, we got into the fact that Delta works for you in the sense that a negative delta is good for bear call spreads, meaning you want the market to go down. So a negative delta, market going down, is good for the call spreads. A positive delta is good when the market is going up and you're bullish and you have the put spreads, okay? So depending on which spreads you have, then you want delta to move in your favor. Now, for instance, here's where delta works in your favor. If you put on a bear call spread, meaning you're synthetically short, and the market goes down, delta works for you. So whatever you sold your credit spread at, besides the time decay that's always erasing, delta moves in your favor. If the stock doesn't move and the spread doesn't move, delta doesn't really decay very much over time. But the more it moves away from where when you initiated your position, the more it does help you. And that's why it helps these spreads, because these are vertical spreads. You're anticipating movement to happen. And if the movement happens, the delta helps your premium erode right away, just like the time decay. So in other words, like for instance, you put the spreads on, 5 days later, you still have another week and a half to go. You're up money, and then because there's a major move in the stock, delta would have really helped you with that. You still would have a time variable where that would be keeping that premium a little bit higher, but because if you have a major stock move it, so yes, you can use delta if you have an explosive move that goes in your favor of your spread. Absolutely. And then you can get out of it quicker, or you could even put on a different spread to look into at that point, which is a whole nother thing, and that would be a more advanced technique. Let's see, real quick, we only got a couple minutes left for questions, but I'll get through these, I think. How do you find stocks you want to apply credit spread strategies for? Right off the bat, I look for the most active and most volatile stocks. And then you look for the pricing, and then it depends on what you want to do. Like for instance, like I said, with the Amazon ones, especially, like, think about this. Let's say you own Amazon stock. You had that monthly sell signal and the daily sell signal, and you're just like, oh my gosh, Teddy, I know I should take a little off, but I just don't want to do it. Well, that's where you put on the credit spread. Instead of selling covered calls and being like, oh, I'll just take the heat and now I'm giving up all this profit as the stock goes down. Well, why not make a little bit more money on it? You know, so, and plus a covered call, you could always get exercised on, you know? So, I mean, like, or excuse me, not that you would get exercised on it, but you won't have a bang for your buck or return on your investment like you would with a credit spread. So in that case, the long-term Amazon bull, it's like, I'm staying long Amazon the rest of my life. Well, when you get sell signals, you put on a credit spread. What's the worst thing that's going to happen? You just lose a little bit of money, or you absorb part of that quick short trade right off the bat. Amazon comes along, and all of a sudden you have more money in your account and value than you would have before, especially because, as far as I know, Amazon's not paying any type of big dividends anytime soon. So putting on credit spreads every time they break, or even if you still don't have the money to buy Amazon, that's when you put on your bullish put spreads. For those of you that can't buy it, look to find some good ones, especially if you can get a good spread rate on it, then you're really getting a bang for your buck. So let's see, as I understood to be successful credit spread, I need to be correct with my assumptive direction. Yes, okay. Yes, this is correct. To be successful in a credit spread, you need to be correct with your assumptive direction, or the market needs to not move at all. Remember, if the market doesn't move at all, time decay will work and expiration will eventually happen. So, so which strategy I need to use if the market moves sideways? That's a whole nother question. If you're expecting sideways movement, the good thing is that if the market moves sideways, theta works in your, remember, time decay, that works for you right off the bat. So if the stock never moves and you sell a credit spread, no matter what, come expiration, if the stock doesn't move or it goes sideways and stays within the strike, below the strike price, whether it's a call spread or above the put first put, if it's a put spread, you're fine. You're good to go. Let's see, I understand the buy and sell of the credit spread. Please explain how you get out of the credit spread. Really simple. Just like in a call spread, you're buying the first call and you're selling the above call. You're just going to do the opposite. You're going to sell the first call and you're going to buy back the other call. Now, on your trading platform, you can usually, depending on how you entered it and what you're doing, you can just put that in together. So you don't, it's a very simple execution. So, and usually what you can do when you have a spread on or any type of trade is you can get out instantly. So the platform will get you out. So as far as getting, it's not a complicated thing to execute. You don't have to be like, well, which one do I do first? You know, you can do it simultaneously and then you're in and out. It's very, that's the one nice thing about the computers. They made that much more simple. Let's see, do you mainly use a specific strategy, iron condor, credit spreads, etc.? Let's see, I'm going to answer these last three questions real quick. Iron condors, that's much more advanced. That's actually would be a good one for a webinar in the future, depending on what I'm looking to do. Like, remember I gave you those examples of the Japanese candlestick patterns, the sell signals, the bearish engulfing lines. In that case, credit spreads is definitely what I like to do. I trade predominantly FX and futures markets and also options and binary options. This is when I trade options for the most part. I'm selling them and I like credit spreads. That's what I like. You know, I like to take the money up front. I know what my risk is and I can just forget about them once I put them on for the most part, unless the market goes the opposite way, in which case then sometimes I'll get out of them first. So how long do your trades stay open? Once again, these are short-term ones that we looked at for the most part. So you're only in them for like a week and a half. Okay. Let's see. How do you close if one leg ends up in the money? Okay, well, I think that was the answer, because you're getting out of both simultaneously. Which is better? Which is a debit spread better than a credit spread? Well, credit spread is better because you get paid up front. Debit spread, you're buying it, and then you know exactly what your risk is because you already threw it out there, so you can't lose more than you already paid out in a debit spread. Let's see. Can you get both a bearish and bullish position so that you can benefit either way? Last answer, absolutely. That Pfizer thing, you could have put on both of those spreads. In any case, any spreads, you could put on a credit spread, which is a bear call spread above the market, and a bullish put spread below the market. If the market stays within those parameters of the first call and the first put, then and goes sideways, both credit spreads in that case would yield a profit. So yes, if you're looking for a sideways market, which I actually do that every once in a while in the futures and also in equities markets, especially if you could pull off a credit spread, a call spread, and a put spread where you can get a premium of $5 or more on both, absolutely do it, because you can't lose. No matter, even if the market explodes, you're going to be making money because you'll bring in over $1,000 on a where you can never lose more than 1,000. So with that being said, I'm going to give you one last plug for me. If you like the presentation, you can check out more stuff I do on my YouTube channel at Forex Trading Unlocked. And if you want to learn about the Japanese candlestick patterns that I use in the example, you can read the book that Gina spoke about that I have written. It's called High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. And for the next 5 days, anyone that wants to can check it out on Kindle for free. So with that being said, we have one last slide here. I want to remind you to register for the next webinar at eOption next Wednesday, January 20th at 1 p.m. I'm going to turn the mic over to Gina now.
Okay, great. Well, thank you, Teddy. That was very interesting and informative. And thank you to all of our attendees today for taking the time out of your busy day and schedule to join us. And thank you for your questions. Those were excellent. And if you want to trade some of these strategies, like a credit spread or option strategies, don't forget to take advantage of eOption's low rates. All stocks and ETFs are zero commission, and options are just 10 cents a trade plus, 10 cents a contract plus $1.99 a trade. And also we do offer a powerful trading platform, mobile app, free tools to help you strategize, live expert support, and free education. So strongly encourage you to go to eoption.com and you can check this out and find out more details on each of these items. We'll also have a video recording available later this week of the webinar today, as well as all of our past ones. So again, you can go to eoption.com and just go under resources. You'll see an education tab. And that also will have our upcoming webinars as well as all of our past ones. And as Teddy just said, we hope you can join us for our next webinar. That's next Wednesday, January 20th at 1 p.m. Central or 2 p.m. Eastern. And it's on gaining an edge during earnings season using Options Play. Now, Options Play is our free strategy trading tool. What it does is it scans thousands of stocks each day and comes up with potential option trade opportunities, and it just puts a spotlight on those for you, and it's linked directly to our trading platform. And normally that's $500 annually, but it's free to all of our customers at eOption and InvestTrade. So if you are interested in this webinar, please go to our eoption.com and you can sign up. And we'll also send you an email to that effect so you can sign up. We do normally do 1 to 2 option trading webinars a month, so I would just keep an eye out open for that. And again, as it says on the page, we hope you'll subscribe to eOption's YouTube channel. We have lots of educational videos on there on specific option trading strategies, as well as our trading platform and how to use it and some of the special features such as customizing it so it's exactly the way you want it, customizing your charts, your news. There's lots of great resources on there, so we hope you'll subscribe and check it out. And if you have questions, I mean, one of the great things about our company is that we do have a live expert support support team, where most of the people on the desk have over 10 years of experience. So they are happy to answer any of your questions about the platform, about trading strategies, option trading strategies. That's an excellent resource. So we encourage you to give us a call, or you can also send us an email. And if you go to eoption.com, you'll see a contact page. There's lots of ways to contact us, but we are available if you'd like to speak to someone over the phone. So again, thank you so much for attending. We know you have a busy day, and we appreciate you taking the time out to join us. And we hope, please be safe, and we hope to see you at our next webinar next Wednesday. Thank you, and bye now.